Hello, welcome to 30 Minutes. I'm Rick Anthony. For several years, I've known today's guest, Mike Dever, as an entrepreneur, a serial entrepreneur, specializing in the internet, creating successful websites, exiting and making a few dollars along the way. Only recently did I realize that there's another dimension to his life, and that has been there for almost 30 years. I simply wasn't aware of it. Mike is also a successful investor, an astute investor and money manager. Even more recently, I learned that he's an author. And so our subject today is Jackass Investing, Mike's new book that lists several of the myths about investing, and this should be really interesting. There's also a website behind this. There's a great deal of information that we'll share with you during the course of our 30 minutes. Welcome to 30 Minutes, and thank you for being here. I really was astonished. All the times we've visited and talked, it's always been in connection with a venture and trying to raise money for a venture. And then this. Give us your background. I know you're a local boy.
Correct. We moved this area from Cleveland when I was in second grade. I've grown up in the Westchester, Thornton, Pennsylvania area, actually, for virtually my entire life. And my office today is a 5-minute walk from where I grew up. So I haven't dropped too far from the tree.
The old mill.
The old mill, yeah, right. I renovated 17th century grist mill.
I remember when that was a restaurant.
Yeah. It was a restaurant for about 50, 60 years. Yeah. Great history.
Yeah. All right. And you went to Westchester?
I did.
With a degree in?
Business. Graduated in 1981, but while I was going to school, I also started trading. The gold market, this was late 70s, gold market was taking off. I had just sold a car. I had $5,000 that was burning a hole in my pocket. Had a lot of interest in math and science and business, and was watching that gold market take off and thought, I want to get involved in this. So I bought gold options, led me to gold futures, led me to all sorts of equity trading, futures trading, currencies. And
all self-taught? No mentor?
You know, I had some great mentors, but not officially mentors. I set up a fund, for example, in 1982. And one of the first people I met in the industry was another early newcomer to trading at that time by the name of John Henry. John Henry's since gone off to own the Boston Red Sox. So John and I had a lot of discussions of trading over the years. I certainly shared some of my philosophy with him and vice versa. We set up another fund in 84 where I used outside managers on it, not just my own trading. And the trader I selected for that was a guy by the name of Paul Tudor Jones. Paul Tudor Jones went on to being one of the big hedge fund managers throughout the 80s into the 90s, became very famous. So, I've been involved in the industry for so long, and I've been around some of the early pioneers in the industry and certainly shared thoughts with them over that period.
But again, you seem to live in two worlds, not totally unrelated, but two worlds. The world that I knew was all about entrepreneurialism, websites, the internet, et cetera, et cetera. You never once mentioned any of this in all of I guess over the past 2 years.
Yeah,
so what's your day job? Which one of those is your day job?
So my day job for the first 2 decades was the investing side and trading. In the 1990s, I came up with this harebrained idea for an early stage, what I call internet e-commerce community, where people could come set up their own shops online, called Spree.com. We launched that, and by mid-98, Spree.com was the 7th most trafficked e-commerce company in the world.
Wow.
So pretty quickly, I started getting consumed by that. We had some people approach us for acquiring the company, VCs coming, we had investment bankers for talking about IPOs. So I guess I became distracted by that and moved for the last decade then mostly into the early stage startup business, technology and internet companies. Yes. So the reason you haven't been hearing about this is for most of the last decade, that has been my day job, not the trading and investing. I'm now back into the trading and investing. We've got a new fund that's launching this Thursday night, July 1st, in Asia. That'll be trading globally.
Asia?
Well, it's a U.S. fund. It's a U.S.-based fund, but it's trading globally. So it starts trading July 1st, which is Thursday night for us, but of course it's Asia, July 1st.
Well, you're now going to give us and our viewers a tutorial on how to avoid becoming A Jackass Investor. What was the genesis of the title?
Okay, the book started with an idea I had in 1999, and I wanted to expose the myths of the investment industry. I kept having investors come to me saying, hey, I don't think I need to take any risks. I can just put the money in stocks and let it ride. I actually had one investor who was retiring and said, I'm ready just to sort of settle down and put my money in conservative investments and earn a conservative 20% a year.
When was that?
1999. I did exactly what you did. I laughed. And he came back without laughing. I said, Fred, are you serious? He said, yeah, no, I've talked to someone and I'm going to put it into technology stocks. Well, he came back to me two and a half years later with 1/3 of the money left. You know, it was a shame.
That's
it was
sad,
terrible to see it. But I was getting enough stories like that in 1999 I thought I want to write a book on this, about the myths people are being taught and the way they're being taught to invest. That's, I felt, highly risky. So it started out as exposing the myths, sort of evolved into exploiting the myths. But when I got close to completing the book, I realized what I was really talking about was people taking unnecessary risks with their money. And to me, the definition of taking an unnecessary risk
Is a jackass.
is a jackass.
Jackass investing, don't do it, profit from it.
Correct.
What's the subtitle mean?
Okay, so the don't do it is the obvious part. What you've been taught to do and the lack of diversification of portfolios, and I'll explain through the book why owning stocks and bonds is not diversification. I don't care if you have 500 stocks. So don't do that. Profit from it is that the majority of people are taught to invest that way. And they leave their mark in the marketplace and opportunities that you can then exploit for profit. So I go through the book explaining 20 common investment myths, and then I actually have created a action section on the website at jackassinvesting.com where you can exploit many of those myths with a specific trading strategy.
I'm looking at the table of contents, and I guess I've done all of these things.
I think we all have. And I did write it out of experience. It's not just from observation.
Well, you blow apart 20 myths, according to this. But the one that intrigued me was the one that I kind of grew up with, or at least had accepted, and millions of other people have as well. That is, the best strategy is to buy and hold. We know of at least one organization that was built on that philosophy and continues to do very well, so far as I know. And there is an advocate who started it who argues fiercely for buy and hold, even today. Obviously, you don't agree with him.
No, I don't think there's some strategies if there's a valid return driver. And what I talk about in the book is basing every investment decision on a valid return driver.
What is a return driver?
Okay, so a return driver for buying and holding stocks. Okay, the philosophy behind that is that there's an intrinsic return that are just owned, that's returned to you by owning stocks. The very first myth I go into here is there is an intrinsic return, and that's a myth. There's actually specific return drivers you can identify that make stocks go up. And the two dominant ones, in the short term, it's investor enthusiasm or lack of for stocks. The PE ratio expanding and contracting has more influence on stocks over a 10-year period than any other.
And that's driven by psychology.
Exactly.
Not necessarily analytics.
It has nothing to do, and I've given examples in there of companies that have had great earnings, they've doubled, and their stock has gone down over a 10-year period. Because people have lost enthusiasm, they weren't willing to pay up for that stock as much as they were 10 years prior. The second one is the corporate earnings growth, which over the long term, and it's really a 20-year or more period, does translate into higher stock prices. But in the short term, it's dominated by the investor enthusiasm.
It occurs to me, since I have an interest in the 50-plus, the boomer community, with 80 million boomers now coming through, many of them having lost what they had in their 401ks or the IRAs or whatever, and now trying to recoup, and in a frenzy, trying to recoup. What advice do you have for them? The average person who might, and I've forgotten the statistics, but I think it goes something like this: the average person, boomer, probably has $50,000 to $100,000 maybe in assets, other than real estate, whatever's left of that, and yet they're 5 years away from retirement, at least normal retirement. There's no way that's going to happen. So when that person comes to you, Is the formula in this book?
It's really not. Okay, this book is about properly diversifying a portfolio to give you greater returns with less risk than what's conventionally preached.
Over the long
And
haul.
it has to be over the long haul,
Right.
but part of the philosophy of the book is that even in the short term, you can lower your risk by properly diversifying, and I can talk about that a little bit. The scenario you're talking about is really a bit outside the scope of this book, and the reality is the majority of people, the best way for them to have more money in retirement is to save more today. And in a scenario where they have 5 years or 10 years left, there's almost nothing you can do on an investment front without gambling to try to make enough money
Yes.
to make up for that small portfolio size you start with. The one thing you can do is cut back on the lifestyle, save as much as you can through that period. And so that would be my financial planning recommendation, is first and foremost, save as much as you can throughout your earning years. But as you earn it and put it into something, don't do what was conventionally preached. Don't just put it into stocks and bonds and maybe some real estate and let it ride. Understand what the return drivers are, and that's what this book is about. And then diversify the portfolio so you really are earning returns from a variety of drivers.
Diversification is something we've all heard about for a very long time. But that is kind of in the eyes of the beholder,
Yeah.
how you diversify, and for how long, over how many. There was something else that we talked about. You don't consider yourself a day trader. Is that correct?
Right. Yeah, and actually the action section of the book, where I have portfolios you can track, they're mutual funds, ETFs, that you can just put your money in passively, hang on to those for a long period of time. They have strategies within them that are exploiting return drivers on a more active basis. But you as an investor don't have to sit there and do that day trading. I do have strategies that I lay out where you can trade in and out of ETFs or stocks on a daily basis if you want to take on that extra overhead, essentially, if you have a portfolio that's large enough to warrant that. But you don't have to do that to be able to exploit dozens of different return drivers and diversify your portfolio. I want to make a statement, though, on the comment that I'm in total agreement with portfolio diversification and the philosophy behind it. The problem is that the way it's preached is that there's this small subset of the universe of opportunity that people preach, and it's to own stocks, primarily U.S. stocks, maybe some global diversification, own bonds, maybe throw some real estate in there.
Right.
And what people have learned, I hope, in the financial crisis is that that's not true portfolio diversification.
Right.
There were investments and strategies that made money, and a lot of money, in the financial crisis in 2008. And a properly diversified portfolio incorporates those techniques in it, so that instead of losing half their money or a third of their money, they might have dropped 10%, maybe 20% during that period.
But the whole world of puts and calls and buying long and short, et cetera, is that those strategies? No, those aren't strategies. Those are tactics, I guess.
Right.
Are they in there as well?
I cover some of that in here,
Yeah.
but again, it's not a book
It's
set
not
up
a
for a
primer.
professional investor.
Yeah.
The action section does have, for example, one strategy though that does include, and the book talks about short selling. And short selling is a tremendous, method to employ to diversify a portfolio and lower risk. But not across the whole portfolio, it's part of it. But there's one strategy that I lay out in there that's part of Myth 3 on the website that exploits behavior of people to mistime the market.
Yeah.
And over the last few years, if you'd started that strategy when the financial crisis hit, you would have gained about 50% over this period, instead of being down still maybe 20% in your portfolio.
I never figured out how to make money in a down market. It just seems counterintuitive.
Right. To me, there's no difference whether or not you find a company or a sector or a commodity that you think is overpriced and selling it to profit on dropping than finding something you think is a great value and buying it hoping it'll go up. It's all the same.
Let me just tick off a couple of these. These are the 20 myths that you explode in these pages. Buy low, sell high. We've all been taught that.
Right. So what I do is, with every myth, I'll go in there and I'll say, here's why people think it's right. And the first example I use in there is a friend I know that was managing money for clients, and through the bull market, they would buy a stock if it sold off a little, and as it rallied, they'd sell it again, and then they'd buy it again and sell it again. And my question to him was, well, what happens if you buy it and it goes down more after you buy it? He says, well, we might buy some more. I said, well, what if it keeps going down? What if it turns into an Enron, which I
Yeah.
didn't know of at the time, but what if it turns into a bad company? He says, well, they always come back. That was his mentality, and that's the buy and hold
Really?
mentality. And it works as long as you're in a bull market.
Yeah.
But even in a bull market, what I show in there is under a bunch of different combinations of buying low and selling high, it doesn't outperform just buying and holding, which I also show as an inferior technique later in the book. So buy low, sell high is the exact opposite approach you should try to employ in a portfolio. If you see something that is performing well and it's going up, you want to buy that.
But Warren Buffett is a contrarian investor, right?
Sure.
And I've forgotten exactly the way he said it, but when everybody is in
Yeah,
a
he's good at
panic,
it.
and when everybody's in a panic, that's when you buy. When everybody's buying, that's when you pull back. Isn't that buy low, sell high?
That's taking advantage of the long-term prospects of a company. And I say in the long term, 20 years or more, the corporate growth is what drives, it's the dominant return driver, it's what drives the stock price. In the short term, it's driven by investor emotion. He recognizes that better than anybody. So what he does is he has his list of great companies that he wants to own, and he waits till investors are irrationally
Yeah.
selling those down to prices that makes them a great value. That's different from the normal approach that people take with buy low and sell high, where they're not that discerning about the quality of the actual company, and they're also not willing to hold it for 20 years,
Yeah.
which Warren Buffett may
Yeah.
be
Yeah.
able to hold it for. So they're buying and selling low really based on just the emotion of the crowd, and they're usually on the wrong side of that trade. And the facts and the numbers show that by the fact that over the last 20 years, the average investor has underperformed the market by 5% by timing it incorrectly.
Myth 13, it's best to follow expert advice.
I have a number of different
You're an
examples.
expert advisor.
Yeah, it is. So does it sound contradictory? Maybe, but the reason it's not is the experts I'm talking about are people who are espousing like specific approaches and timing strategies, for example. And what I really espouse is as someone described it to me, your book is a system of thought. And even though I give specific examples of what they can do, it's a thought process that people should follow to make their own decisions. Now, I give specific examples of what they can do as well, and they can follow those precisely if they want to. But my idea is really to let them think for themselves. The example I use in there is an early guru, Joe Granville. When I started out in trading in the early 80s, Joe Granville was the guy. He could move the market. His performance over the last 30 years is somewhere around negative 20% a year now. I mean, he's just destroyed money. And what you find out, I've got numerous studies in there, both academic and some examples of studies at different colleges, where you can see that the more people become an expert, the more locked into their views they get, the more they're on TV, and a pundit now, the more locked in they're getting. And the worse their predictions and recommendations become. One example I give, my boys just got rats for Christmas as a pet rats.
Pet rats?
Yeah, they're great. They're a great pet. And
rats. Okay.
and there was
You
a
live
study
in the
there-
country, right?
Well, yeah, it's still a house, But there's a study in there that was done at Yale where they had a rat find which side of a maze to go to find the food, and it was 60% on one side and 40% on the other. And then they had the students, the Yale students, make the same prediction. The Yale students got it wrong more often than the rats did. The rats, because they started figuring out most of the time it was over here,
Yeah.
they got close to 60% right. The Yale students were close to 50-50. So sometimes being an expert, overthinking,
Yes.
you underperform.
Okay. Before I go to another myth, are you optimistic about the outlook for the U.S. market?
I don't have individual views on each market. My approach, and we talked about earlier, you say you're not a day trader.
Yeah.
My approach philosophy is to identify return drivers that have solid long-term probability of driving the returns of any given market, and then systematically backtesting to find out whether they are effective, and then employing those on a systematic basis going forward. So overall, I don't sit there with an opinion on a market, but that's a great question, because one thing that I have done systematically is look at what has driven the returns of the U.S. stock market in the last 30 years, and what that indicates is that over the next 10 years, the likely return is about 3.5% a year. And the likely return from bonds is
3.5.
somewhere under 3%, the average bond return. And that's really coming out of a couple major factors. One is that the majority of the return of stocks from the bear market ending in 1981, 82, it doubled in prices from the PE ratio doubling. The others, you had strong earnings growth, and you started that period with dividends of over 4%. So today, you're starting with, you don't have the return driver of this expansion of PE to expect.
Right.
It's actually, it looks like about a third contraction of PE from the long-term sort of average PE to get to where it will be in 10 years. Dividends are starting 2%, not 4%. So if earning growth stays the same as it was over the last 30 years, over the next 10, stocks will return about 3.5% a year, not the 9-10% that they had.
That's not good.
And bonds where people started in, and
Yes.
you had now the average sort of bond duration is maybe 5 years. People are in. So a 10% annual return on bonds was earned because that was about the average duration in the early 80s. Or the average yield on the average duration. Today, the average yield is under 2% for 5 years. So what was 10% as our likely return starting in the 1980s is now 2% for bonds.
It's a formula for a catastrophe when inflation starts taking off.
That definitely, absolutely. And what you see and what you've been seeing is people doing, again, the exact wrong thing at the wrong time over the last couple of years, pouring money into bonds because for 30 years that was the safest place to put your money. It earned more than stocks for one of the only times over a 30-year
Yes.
period with smoother returns. So people poured money into bonds at the time when bonds now are likely to yield maybe 2% over the next 10 years.
Regardless of the class of bonds, corporate versus munis.
Yeah, they're not. When you look over a 10-year period, it sort of starts coming out in the wash. You'll have bigger volatility in some of the corporates and the munis lately, but over the long time, looking at a broad bond portfolio, it's in that 2% range.
Okay. On your website, Brandywine Asset Management,
Right, that's brandywine.com.
brandywine.com, there is this illustration, and the top one is market diversification, the second one is strategic diversification. You won't be able to see this, folks, if I put it up, but explain, please, the difference between the two.
Sure.
And I assume the second one, strategic, is the one you are prescribing.
Well, both.
And what are the elements of diversification?
Right. Okay. So to me, strategy diversification comes in one main form, and that's the trading strategy that's being employed, and having multiple trading strategies. And a trading strategy, as I lay out in the book, is made up of really two primary components: a market that you want to exploit the behavior of, and a technique for exploiting that behavior. And so it's markets and it's strategies that make up a portfolio. And we're looking at markets that are globally diversified. There's no reason to ignore some of the best markets in the world for exploiting, which some of the commodity markets, for example. People talk about gold now. Well, gold is just one of dozens of potential non-financial, some people consider it financial, markets that you can trade.
Give me another couple of examples.
Agriculture markets like wheat or soybeans or corn, or metal markets, anything from like the nickel up to the gold and the precious metals, the energy complex, the crude oil and natural gas. And over the last couple of years, a lot of funds have been formed to take long-only positions to exploit those markets rising in price. But there's other strategies to take advantage of, actually some that take advantage of the way those funds are structured, to take advantage of the term structure in the markets between crude oil selling this year and crude oil for delivery next year that you can make money on. So what I talk about is the opportunities that are present in all these different return drivers that can be developed into a strategy to exploit specific markets and return drivers in the portfolio. And if you combine those, you end up with hundreds of different return drivers in your portfolio.
It sounds like too many different options.
If every one of them
for the average person.
Well, and it does, and the average, this is full-time business.
Yeah.
Okay, and you're competing against professionals who have it as their full-time business as well. So most investors, if they just jump in here and try to do it themselves, will turn into the meat for the professionals. So you probably don't want to do that. But there are funds, ETFs now. There's a lot of private funds that, like our fund is a private fund that you can't really find publicly advertised.
Okay.
That people can find, and I give some ways of finding them in the book. Myth number 12, for example, I give some examples of ways to identify methods for exploiting these.
Futures trading is risky?
Correct.
Number 12?
Correct.
Okay. Allocate a small
Remember,
amount.
that's a myth.
Oh, yes. I have to remind myself. These
Exactly.
are not prescriptions.
myths.
These
Yeah,
are
and
myths.
What's interesting in that chapter is I go through and show examples of different futures trading indexes that have tracked futures managers over the years. And they dramatically outperform on a risk-adjusted basis as well as absolute basis returns from just buying and holding stocks.
It's bad to chase performance because it's not really predictable, I guess.
The norm.
Although, before we got started, I was asking you whether or not history really is prologue in the work you do. And I think your response was, for the most part, yes.
You need to identify the return drivers and determine whether they're still valid today as they were valid in the past. People that look and say, I can buy stocks and they provide an intrinsic return, look back over the last 110 years, I could have earned 10% a year. Well, is the return driver that powered that valid today as it was then? We were an emerging country, developing country that had tens of billions of dollars in GDP. Today we've got $14-15 trillion in GDP. Okay, so by definition, we can't be what we were then, unless, of course, we have a collapse and then we reemerge, which doesn't bode well for buy and hold stock investors. So my whole thinking on it is you got to determine whether or not the return driver is valid. So that chapter that talks about buying essentially trends and trend following does exploit a behavior that's been prevalent for centuries, in that people tend to reinforce and redo whatever they've done that's worked in the past. So they start buying gold 5 years ago and it's going up, they'll buy more today, or they'll tell their friends about it and they'll buy more, and it perpetuates trends. Totally stop.
So as an observer, a commentator, an analyst, to do this the way you've done it, and to develop the formulations that you have to be obviously an astute business person, have an analytical mind, be an economist, a psychologist, a sociologist. All of that goes into understanding human behavior and identifying the drivers. Now, the drivers, are there 2 or 3 or 4 of them that are particularly relevant today in a down economy on a global basis? Every major economy struggling, Greece about to go under again, and other countries not too far behind them. What are the drivers?
Well,
on a global basis, not just, or are they different country by country, economy by economy?
They're an example of return driver. Okay, so in myth number 3,
number 3, you can't time the market.
Can't time the market. Okay, all the studies show the average investor can't time the market. So Dalbar, which is one of the
only the
more
average
popular.
investor? What the experts can't time the market,
and that's in there as well under the expert chapter. And what I talk about with experts is they're just other amateur individual investors with more money. They have more zeros. Their behavior is almost identical,
and they're forgiven.
And they're forgiven, or if they're not, they still pocket the money and they go home. But the average investor underperforms by 5% a year. The mutual funds, the performance of the mutual funds they invest into. And that's because they see something that's hot and they jump in, and it's bad and they jump out of it. And so one of the return drivers I have that I actually show specifics of on the action section on the website, jackassinvesting.com, is exploiting the behavior of those individual investors by looking at when they're moving in and out of ETFs. And it's so predictable that when they're flooding into long ETFs and stocks, you're nearing a peak. And you can sell short or you can get out and you'll make money. And when they're going the opposite way, you want to be buying stocks. So I'm looking for individual return drivers like that then you can just patch into a broadly diversified
Speaking of
portfolio.
selling short, the control room says we're out of time.
Yeah, okay.
And this is fascinating. The book is Jackass Investing. The website is www.jackassinvesting.com.
Correct.
You can purchase the book on the site, Amazon as well.
Amazon as well, yep.
That's great.
It's hardcover, paperback, and Kindle.
Thank you for being here. I'm going to
Thank you, Rick.
invite you back because there's so much more we can cover here. I think it would be interesting and useful.
I appreciate it.
So until next time, this is 30 Minutes. I'm Rick Anthony. Thanks for watching and take good care of yourselves.